Hello and welcome to video 5 of your training. In this video we're going to talk a little bit about currency pairs to trade, time frames to use this particular trading system with, and I'm going to give you an easy money management system. For your success as a trader, you should always use a proper money management system. It's the #1 way to ensure that you stay profitable and don't experience huge drawdowns on your account. Money management isn't difficult. It just adds a little bit of time to each trade. I'm going to teach you an easy system to use to ensure you have a profitable future in Forex. To begin with, let's just talk about currencies and time frames. Since this system is very much a trend system, we're trading with the trends. You should try to stick to currency pairs that have a tendency to trend. Now, any currency pair will actually do this at one point or another. Some of the ones that are easy to trade and are trending all the time include the Euro US dollar, the British pound US dollar, the Euro British pound. The US Canadian dollar has a tendency to trend for long periods of time. US dollar Japanese yen, British pound Japanese yen, US dollar Swiss franc, and British pound Swiss franc. All of those currency pairs have a tendency to trend. Some of the easiest ones are the ones that you're going to be more familiar with. For example, if you're in the US, you're more likely to know the US dollar better than any other currency pair, so you should stick with a pair that includes that. If you're in Europe and you use the euro, maybe you would stick with a currency pair or start with a currency pair that included the euro. You're going to be more familiar with what's going on in the area, and you'll be more able to get notifications if anything changes with the economy or anything like that. So that's my suggestion. Stick with one of these currency pairs which have a tendency to trend, and try to start out by trading a currency pair that is your local currency if you can. Best time frames to use with a system like this. The best time frame when you're starting out is the 1 hour charts, but you can also trade the system with the 4-hour or daily time frames. You wouldn't want to go to a shorter period of time, and if you did move up to the 4-hour or daily time frames, you might want to use a 60 pip or 80 pip stop instead of a 40 pip stop. When you're starting out, stick with the 1 hour charts, and if you want to try something new as you learn the system well, move on and try it with the 4-hour and daily time frames. The longer charts will give fewer false signals, but then of course you're also going to get less trade signals in general. And then finally, let's talk about money management a little bit. As I said before, this is one of the most important things you can do to stay profitable. Money management allows you to risk less, or at least manage your risk, and grow your account more over time. So let's give you an easy system to use to manage your money in Forex. The money management system that I'm going to cover is a simple one that will allow you to vary your trade size so that you're always risking the proper amount. It's quite a simple system to use. All we need to do to use this system, we need to know our stop loss. Doing that with that information, we can calculate a per pip value, and from that calculate the amount that we're going to risk on any given trade. And then we can use that information to vary our trade size according to our account balance at the time. This will all become clear as you get through this video, so let's just talk about this. First thing you need to understand is how to calculate a per pip value. This isn't really difficult. We need to divide 1 pip with proper decimal placement divided by the current C exchange rate at the time, and then multiply that by the amount. So for example, with a US dollar Japanese yen pair, a proper decimal placement for a pip is 0.01. With any other currency that didn't include the Japanese yen, it would be 0.0001. In this case, it's 0.01 divided by the exchange rate. If it was 92.52, we would divide by that and then multiply by the amount that we're trading. So if we were trading 1 lot, we would multiply by 100,000, and that would give us the per pip value of $10.80.87 or 10.81. When the US dollar is on the right side of the pair, so in a case like the Euro US dollar, where the US dollar is over on this side, we don't need to calculate a per pip value because we know what it is. A full lot is always $10 per pip, and a mini lot is $1 per pip. With any currency exchange or currency pair that has the US dollar on the left side of the pair, you need to calculate a per pip value just like this. With our per pip value, we can now calculate how much we can risk on a trade. So from using the number we calculated before of 1081, if our stop loss is set to 40 pips, then 40 times 1081 means for every lot that we're trading, we will be risking $432.40. And from that, we can also work to calculate a trade size and then calculate how much we are allowed to risk. Your proper trade size is always calculated from your current account balance. And to calculate it, you should use a % R or % risk level. We always limit our risk to 2%. As a more experienced trader, you might move that up to 3%, but especially when you're starting out, 1% or 2% is a common number. So if your account balance was $120,223, we could risk 2% of that, which is $2,404.46. So then we can then calculate a trade size. That's quite easy to do. We just go allowable risk divided by risk per lot equals the number of lots to trade. So we calculated 2404.46 is what we're allowed to trade, and we calculated that we were risking $432.40 on every lot traded. So that means on this trade we could use 5.56 lots as a trade size. In most cases, you obviously can't trade that, so we're going to round down. If you were trading full lots only, we could trade 5 lots. If you had an account that allowed you to trade both full lots and mini lots, then you could trade 5 lots and 5 mini lots, not 6. We always round down. And with this system, since we're using multiples of 2 lots, you would divide the number in half. So if you calculated that you could trade 4 lots, you would trade 2 lots on the first lot, would be considered the first lot. When we were exiting with that 40 pip stop, we would actually trade 2 lots at that time, and then leave the other 2 in the trade as our second lot. And it isn't really set in stone. If you could trade 5 lots, you might trade 3 as the first lot and then 2 as the second lot, or vice versa. You can vary your trade size a little bit here. What we want to ensure that we do is always risk less than the full allowable risk, and you should keep it as close to your allowable risk as possible. That will help you grow your account over time. And just to close out this training video and the whole training series, just wanted to leave you with some final thoughts. Before trading any Forex system, you should practice until you understand it well and feel you will profit from it. The more you trust a system, the easier it will be for you to trade. And when you begin trading a system that you trust with real money, you'll be much more likely to profit from it. So practice until you're comfortable with it and it works for you. Whenever you trade, even if you're just using a practice account, get used to using money management. It's important. And when you're beginning, instead of trying to trade 5 or 6 different currency pairs all at once, try sticking to 1 or 2. This is going to help you when you're learning. It'll help you to learn those pairs well and see how this particular trading system works with those pairs, and you won't have to worry about the differences between 5 or 6 different currency pairs. You can just focus on 1 or 2, and it will make the whole learning experience easier.